Hello and welcome to the Construction Record Podcast. I'm digital media editor Warren Fry. On this episode, we have highlights from the Build Beyond Today, the Construction Economy Outlook Spring webcast, held by ConstructConnect in partnership with the American Institute of Architects and the Associated General Contractors of America on May 9th. Our first clip is American Institute of Architects Chief Economist Kermit Baker, who addressed how pressure is finally easing on supply chains.
One problem that does seem to be largely resolved is supply chain disruptions that were so prevalent during the early days of the pandemic. So this is an index that measures global supply chain pressure, basically how much volatility we're seeing across a broad range of global products. And this was developed by the New York Federal Reserve Bank. The current figures indicate that supply chain pressure has been reduced significantly in recent months, and basically back to normal levels, or at least back to levels we were seeing prior to the pandemic. This movement is a result of companies choosing to shift their production to areas likely to have fewer disruptions, as well as adding redundancies to their supply chain so they won't get caught short as they did during the pandemic. So as a result of these production shifts, the manufacturing sector has been the strongest major construction sector in recent years. And there's several reasons for this strength. One is that supply chain concerns during the pandemic encouraged companies to bring back some production to avoid bottlenecks, as I mentioned. Secondly, high-tech concerns about depending on foreign countries for inputs. The Chips and Sciences Act, for example, provided subsidies for some of this activity. And third, more plentiful domestic gas and oil production make manufacturing of products utilizing these inputs, things like plastics of note, more cost effective to be produced domestically. So we're seeing more of that. So here we've got trends in manufacturing employment that were created by reshoring and foreign direct investment. And we've seen this employment more than double over the last 5 years and increase sixfold over the past decade.
Next, Associated General Contractors of America Chief Economist Ken Simonson looks at both job openings in the construction industry and changes in how the sector is spending.
And you can see that there's been huge growth in employment that's continued right up through February. We have had a further report covering April just came out after I sent these slides, and to my surprise, still another gain in residential construction employment. Now, non-residential construction employment has also done well over the past 2 years, but it had a full year of not moving from June of 2020 to August of 2021. So non-residential construction employment is only now back to where it was just before the pandemic hit. But as the next slide shows, there has been quite a bit of variation from one state to another. Fortunately, nearly all states have added jobs in the last year. This is updated through March, and it shows that 44 states did add construction employment over that time. Only 5 states are still lagging. Construction firms wanted to hire even more workers than they were able to. This jagged blue line shows the number of job openings in construction at the end of March in each year in the history of this series, which goes back to 2001. And while there was a decline from March of 2022 to March of this year, nevertheless, it was the second highest number of job openings at the end of March in the history of this series. The red line shows the number of people hired during the month of March. And there were almost as many openings at the end of the month, 355,000, as were hired during the whole month. The implication, therefore, is that the industry wanted to hire almost twice as many people as it was able to bring on board.
Kristy O'Brien, ConstructConnect's Director of Private Content Acquisition, gave an update on bid projects in Canada and projects in the United States as well.
Canada bidding tells a very similar story to the United States with the same conclusions to draw from. In Q1 2023, non-residential bids are measuring 29% ahead of 2019 and 24% ahead of 2020. 2021 and 2022 saw growth compared to the 2 years prior. This year's Canada bidding is trending at the same rate as last year. U.S. planning project data consists of projects in any pre-bid stage. On par with bidding, Q1 planning projects this year are experiencing a decline compared to Q1 2022. We're trending at negative 7% this year compared to last, and slightly ahead in comparison to 2019 through 2021. Our planning market has remained strong throughout the pandemic years because regardless of the outcome of when the project moved forward, owners and investors were still doing their best to keep working and keep their businesses running. Planning for projects did not slow down, but the approvals and funding did. Currently, economic uncertainties and labor shortages are impacting how those who are funding projects are deciding to move forward with their plans. We've heard from sources that they're waiting to see how the economy looks through Q2 and how that will impact their businesses. Moving through the next few slides, I'm going to review select building uses in which we've seen both growth and declines in the United States and Canada. These are not the only industries, but a select few. So here you can see in the United States, warehouse and distribution facilities continue to grow compared to year-to-date reports in 2022. I'm not sure about you, but regardless of what area I am in, it is rare to not turn a corner and not see some type of warehouse facility under construction. Military, hotels, financial, manufacturing, and amusement recreation facilities are also seeing healthy growth this year compared to last. So compared to 2022, in 2023, education, retail, medical, and restaurants are showing a slowdown in project reporting. Educational funding came in waves throughout 2021 and 2022. With so many educational institutions moving to remote schooling because of the COVID pandemic, there became an unusual window of opportunity to push projects forward, allowing the time and resources to take approved funding and get to work. With the start of this new year, we're seeing those projects slow down to a more expected rate. Canada project volume is considerably smaller than that of the United States based on buildable land mass, but a few key areas saw substantial growth in 2023 compared to year-to-date in 2022. Museums, warehouse and distribution, conference and convention centers, and service stations have seen an increase in project reporting so far in 2023 compared to last year. Like the US, Canada is also seeing a decline in retail construction. So far in 2023, Canada is trending negative 9% in retail construction reporting compared to year-to-date in 2022. Elderly care, assisted living, arenas and stadiums, and fitness and recreation centers are also seeing declines. As mentioned earlier, we're hearing directly from our Canadian sources in these industries that funding and uncertainty of the market are contributing to when their projects will move forward.
ConstructConnect chief economist Alex Carrick says we're still waiting for a recession that has yet to materialize, and he's also impressed by the sheer volume of mega projects currently under development.
So I keep waiting for the shoe to drop because there's all the announcements about layoffs. You keep hearing about this, and it started in high tech and it moved over to retail. And you would expect that the employment situation report would have a nosedive in jobs creation, and that the initial jobless claims figure, which comes out every week, you would think that that would go up. But no, they're still very solid. I mean, initial jobless claims is between 200,000 and 300,000. Nothing to worry about there. And the unemployment rate, not seasonally adjusted at 3.1%, is about as low as it can possibly go. Now, despite all of that, our forecasting partner, which is Oxford Economics, doesn't have very strong growth numbers for GDP this year and next year. They're saying 0.9% this year and 0.4% next year. And they do expect a couple of quarters of probably negative performance in Q3, Q4, or Q4, Q1. So a slowdown is expected. And then we've got these problems with the banks and the debt ceiling and so on. But the stock market doesn't seem to be terribly worried. And at the end of April, NASDAQ and DJI and the S&P index, they were all three of them were up by about 20% versus their 52-week lows, which is categorized them as bull markets. And inflation, which everybody's been concerned about for quite some time, it's improved considerably. It's gone down to 5% year over year. And in June of last year, it was 9%. And I'm particularly encouraged that the food at home sub-index has finally fallen below double digits. It's down around 8%. Gasoline is minus 17% year over year. And a cut in the price of gasoline like that is analogous to a substantial tax cut because everybody uses gasoline. And rent is interesting because rent is plus 9% year over year. And you may think of that as a negative, but there's another side to it, which is that that's an incentive for multi-unit construction. So what I talk about when I talk about the construction scene, the one I focus on, what I focus on most is all these mega projects. I've never seen anything like the proliferation of projects of $1 billion or more each that we saw last year and through the first quarter of this year as well. And there's 4 or 5 main drivers of this. I would say that point number 1 is the whole effort at decarbonization, which means a lot of industries are trying to build plants that will satisfy carbon reduction targets. And that would be the auto sector. Then you get the battery plants, and then also production of hydrogen and ammonia, and carbon capture and storage, and direct air capture. There's something called DAC, which is like trying to scrub the atmosphere. I can hardly believe that these projects are going ahead, but they are. And then the second really big thing pushing the mega projects is bringing jobs back to America from overseas. And in that category, you get the really big chip making plants. And then as a third factor, you can't forget fossil fuels because there's a huge advantage in price for natural gas in North America versus Europe and Asia. And that means LNG exporting projects, which are usually like $10 billion, and other kinds of energy projects. And then a fourth point would be that Washington's offering all kinds of incentive measures in terms of taxes and grants and so on. And then a fifth factor is demography, because the population is aging. And if you go through these lists, there's actually some major hospital projects. There weren't hospitals construction, there weren't big hospital projects being built during the pandemic because all the focus was on taking care of people. But they've come back. They've come back with a vengeance. So the question is, what does this mean? What are the implications of these mega projects? Well, they really change the nature of the construction sector, because if a mega project comes to a town near you, then you're going to see some pretty significant impacts in terms of possibly the cost of land, for example, labor requirements. Workers want to work on these projects because usually the pay is more and the jobs are fairly stable. And a mega project will tie up local contractors, and it'll tie up some of the really big contractors across the nation as well. Now, there's an aspect of mega projects that I did not include on this list. And one of my esteemed fellow colleagues on this panel session, Ken Simonson, recommended a book to me called How Big Things Get Done. How Big Things Get Done. And there's 2 authors, Bent Flyberg and Dan Gardner. And Bent Flyberg is known as the world's authority on mega projects. And he points out that mega projects are notorious for cost overruns and not meeting completion dates. And he pushes the idea of think slow so that you can act fast. And the thinking slow part of it is really plan out these projects before you go ahead with them, because it's the change orders and all the changes that you do on the fly that really runs up construction costs. So really try to plan these projects ahead of time.
Finally, here's ConstructConnect senior economist Michael Guckes with a look at put in place versus new construction and some operational takeaways from the webcast.
So if we look at our put in place, there's a couple of ways to look at it, not just by vertical and geography, but also by new construction and renovation. And this is the really interesting part about some of the ConstructConnect data is our ability to break it up by various segments or elements, right? And one of those is renovation work versus new construction. And this is where you see a big difference in our forecast out the next several years. So I think it's important to understand that renovation put in place spending is going to be up 43% in our forecast, which again, we work with Oxford Economics on all of our forecasts. So 43% over the next 5 years ending in 2027, you're looking at about a 7.5% compound annual growth rate, or CAGR. On the other hand, of course, you can see it's a little bit of a different picture on the new construction side there. But I don't want that to be a negative. I think one of the things we need to realize, and why I have the history here, is that we're already at quite a plateau. We've elevated that new construction put in place spend over the last several years. And so to maintain this elevated plateau, that's not necessarily a bad thing at all. I think it speaks well of the future of the industry. For the new construction, again, new put in place, a regional view. This follows, I think, very carefully or very much along the same lines as what Ken had pointed out with his population and demographic data. But those states, those regions of the country that are seeing the greatest demographic growth are the ones that are also seeing the greatest construction growth. And that makes a lot of sense. As I've seen through the NAR's data, that intra migration, where people are moving from one state or one region of the country to another, we're certainly seeing a bit of a sucking of people from the West and from the Northeast into the South. And that certainly has been reflected in these numbers, both historic and forecasted. And you can see that the Midwest, the North, and the South, they all are struggling a bit more in terms of how they're going to grow over the forecasted period. Labor, because of its eroding productivity and its rising cost, some of the other speakers mentioned 5 to 6% year on year is the rising rate of construction labor hourly wages. You have rising wages, decreasing productivity. That's a real risk to your operations, much more so than material costs will be moving forward. Of course, material costs were the real challenge in the years immediately after COVID, right? Your pre and post COVID supply chain strategy, it's going to certainly look different for the reasons we've talked about, but also we need to be aware of what's happening on an international basis. The delivery time indices, right? Measures of how long is it taking supplies to go from China to the US or from one part of the country to another, right? All of these measures are suggesting that we have a lot more slack in that system than we've had in a long time. Some of those measures are essentially back to pre-COVID levels. So again, the idea that we need to have these domestic only supply chains or these very geographically close-knit supply chains, I think that is going to need to be hybridized. We're going to want to have some of the advantages of that, but from a cost perspective, you're going to see that quickly falling trucking prices, very quickly falling international ocean-going ship prices are really going to bring back, the attractiveness of imports, and we're already seeing that on the Chinese import data. The import prices are already in the negative single digits. They are getting cheaper, and so that's again something we need to bring into the calculus once more for those construction firms looking to come up with the supply chain of 2024 and beyond.
Thanks for listening to the Construction Record Podcast. You can hear us on Amazon Music, Apple Music, and Spotify, as well as the Daily Commercial News and Journal of Commerce websites. Thanks for listening.